What's going on, everybody? So today, we're getting towards the end of our mentorship here, and you guys have learned a lot of shit. All right, now today we're gonna be going over basically just how to deal with or overcoming whatever loss that you have or will be going through in the future when you are, basically trading, right? Now, when you trade, right, you're going to endure some losses. So, imagine you're short here, took a short here, took a short here. Both got stopped out, right? You both, or both of these trades got shorted and both of them got stopped out. Now, let's say you had $100,000, right? And remember our risk management rule. You want to risk 1%, right? If you risk 1% on those two trades, okay, you risked 1% on those two trades, that means you would have been in 2% drawdown, okay? So, with 2% drawdown, that means if 1% of $100,000 is $1,000, you would be down minus $2,000. How are you going to overcome this? How are you going to overcome it? Remember our risk management rule of 1 to 2 risk to reward ratios. If we shorted this, was aiming for a 1 to 2, and we shorted this, I was aiming for a 1 to 2, what are we going to do now? Price is continuing to go higher, but we got stopped out and we lost 1% of our account on both trades, right? How are we going to endure this? We're going to go back to basics. We're going to be focusing on our risk management plan, which is going to be risking 1% to make at least minimum 2% back, right? And we'll also be focusing on our basics, which is going to be our basic market structure. When we go back to the beginning of this mentorship and you guys learned about market structure, you guys are going to be looking at, market structure shifts, liquidity sweeps, intermediate, short-term, and long-term highs and lows, paying attention to breaks of structures, displacement. You're going to be paying attention to basic PD rays, fair value gaps, and order blocks. We're going to be paying attention to those as well. So we want to be looking at multiple basic things. We want to be looking at structure, order flow, and PD rays. Those are the three things that we want to be looking at when we have taken these losses. And just for an insight, maybe these are 2 losses in the past 2 days, right? You took 1 loss on Monday, took another loss on Tuesday, and now it's going to become Wednesday or something like that, right? So when we pay attention to that, imagine this was day 1, right? We took a loss here, so day 1, took a loss here. This is day 2, took a loss here. Now we're on day 3 and we're in 2% drawdown. How are we going to overcome this? Let's give our first scenario first, okay? Imagine we took these 2 losses, right? What the average person is going to do is he's going to take that third trade, and I'm just giving an example that it's 1 trade a day, right? He's going to make that third trade and he's going to risk double these combined. So 1% plus 1% is 2%. So he's going to risk 2% on this trade, right? And he's most likely, because of that, he is most likely either going to get stopped out, or he's going to go into a little bit of profit, or he might even win the trade. Who knows? But that is gambling, and we don't want to do that, okay? We do not want to gamble. Okay, so we do not want to gamble, and we want to pay attention to our risk management plan. So if we took this trade on day 1, took a loss here. Took this trade on day 2, took another loss. We're down 2% on our $100,000 account, right? So if we're down 2%, right, on the third day, the average person will usually double up the risk and risk double whatever these risks were together into this. So the average person would have risked from 1% and 1% to risking 2% to make 4%. So not only gaining the losses back, but also at the same time, they're trying to get into profit, to be in 2% profit, hypothetically. That is gambling though, and we don't want to do that. So I'm going to show you guys what I recommend you guys do when you are in this predicament of taking 2 losses in a row. So if you guys were risking 1% and 1%, what you guys should have done is, if you took that first loss on day one, what you should have done was cut this loss, or cut the risk here, to prevent the loss from being even bigger. So what you should have done was, from risking 1% to make 2%, on the next trade that you take, you should have started risking 0.5% to then trying to make 1% out of 0.5%, so that you can get back this loss and maybe even get a little bit of profit in. Reason for that is, if you took a loss here, you're not losing another 1%, you're losing 0.5% of your account. So in total, with these two losses, if you risked 1% on both accounts, or on both trades, you would have had a total of negative 2% drawdown. If you risked 0.5% here after you took that first 1% loss, you would only be down 1.5% drawdown, which is less money you have lost now. So you are controlling your risk. So right here, I'm going to put the percentage of risks that you should have done. 1% here, took that first loss, 0.5% here, took that second loss, right? So because of that, on this third trade, you are going to be focusing in, locking in on this one, and you're going to be focusing on de-risking again because you had lost 0.5%. So you're going to de-risk again to 0.25% now. And your goal here is to get a take profit of a 1 to 2, a 1 to 3, 1 to 4, 1 to 5, 1 to 6. You know, getting those decent RRs. But your goal, your short-term goal here, and your main pretty much hypothetical goal here is to get to 1 to 2 risk to reward ratio. So you're either going to catch a long or a short to get a 1 to 2 risk to reward ratio. So if you are risking 0.25, right, you're risking 0.25% of your account now. If you get that 1 to 2 risk to reward ratio, you get 0.5% back in reward. So you carry this loss already. You're already done with this loss. You multiply that by 3, a 1 to 3, you get 0.75 reward back. So you carry this loss, and you're starting to do damage on this loss now. You do it by 4, now you are in 1% profit, minuses off the 0.5%, minuses off 0.5% of this. So now you're only in 0.5% drawdown. And finally, if you do a 5 or 1 to 6 here, you are now taking away both of these losses combined with using less risk. So let's say you took a third loss with 0.25% risk. You are only down 1.75% drawdown. Compared to if you took a loss here with another 1%. All 3 trades were 1% loss. You would now be down 3%. So every trade that you lose, you want to de-risk your risk by half. So if you are risking 1, you're going to go to 0.5. If you're risking 0.5, you're going to go down to 0.25. If you're risking 0.25, you're going to go down to 1.25. And you're going to keep trying to aim for 1 to 2 risk to reward ratios. Okay? And if you do this consistently, this is a mechanical way of showing risk management for yourself so you don't get into deep drawdown for yourself. Alright? So remember that. So I'm going to give you guys pretty much what I would do when I'm in this situation. And this happens to everybody where they take 2 losses, 3 losses, 4 losses, even 5 losses in a row. So what I recommend you guys doing, alright, first thing you guys want to do is you want to go back to your roots, alright? You're going to want to go back to structure, alright? You want to go back to structure. So when we look at structure, right, we're going to be looking at our external buy side and external sell side liquidity, also known as our dealing range. What is our dealing range? Alright, this is going to be where buy side and sell side liquidity had been swept, creating a new trading range. We swept buy side here, we swept sell side here. So this would be our buy side liquidity here, and this would be our sell side liquidity here. So first thing I would do is when I'm in this predicament is I would measure out my dealing range, my current dealing range, alright? Now when I'm in my dealing range, I'm going to be measuring out my premium and my discount arrays, alright? When I'm doing that, I'm measuring out my premium and discount arrays. We are very, very premium right now. So because of that, we can expect one of two things. we can expect us to either take out this buy side liquidity, or we can trade up into an extreme PD array, which would be most likely some type of order block. So either a rejection block or an average ICT order block. All right. So we come down to the 15-minute time frame. We can see here that we have a 15-minute order block here. All right. So we got a 15-minute bearish ICT order block here. We tapped into it multiple times, and even on the 1 hour time frame, we had tapped into it. But specifically, we're paying attention to the 15-minute time frame. So we tapped into our higher time frame PD array. We tapped into a 15-minute ICT bearish order block. So because of that, we want to see some type of liquidity being taken. Where do we get that? We get that all of this buy side here. All of this buy side that had been generated higher into getting taken out here. All right, so we took out all of that buy side liquidity here, and it had been swept now. So we have our sweep of liquidity, and we can even drop down to our lower time frames, which would be on the 5-minute time frame. We had swept all of this liquidity here again. All right, so we swept all of that liquidity as well. So we got all of this buy side that had been swept. What's the next thing we want to be paying attention to? We want to find a 5-minute or 15-minute market structure shift. So we want to see a shift in market structure, and we get that right here, all right, on the 5-minute time frame. 5-minute time frame market structure shift. Next thing is a fair value gap. We don't have any fair value gaps. So what do? Drop down to the 1-minute time frame. What's on the 1 minute? Inverse fair value gap here. We can use this inverse fair value gap for an entry for ourselves if that is what we desired. Alright, and this is a lower time frame model that we could use for a potential run for price. Now, let's say we didn't catch this, right? We didn't catch that. What we're going to be paying attention to now is we're going to be waiting for that indefinite market structure shift, which will be displacing over this low right here. That is going to be what we're waiting for our displacement from. So we want to displace through this low to then drop even lower. Or we want to see us run through buy side liquidity. So if we play it out price and time, boom, we get huge displacement here at 8:30. I do think we had news during this. So we do get our indefinite displacement through here as well. And now we're coming back up. And why do we not have our market structure shift here? This is the highest high. This is a lower high. This would be a break of market structure, not a market structure shift, because this is not the highest high. This is a lower high than this high. This is the highest high of this current displacement range. So because of that, we look at the previous swing low before creating that higher high. Low, high, lower low. So because of that, this displacement here, we need displacement through that low. That would be our indefinite market structure shift to then see that we would be going bearish again. All right. So because of that, we can anticipate some type of comeback up into something. Now, what could that something possibly be? We could most likely, because we tapped into this order block, there is a different PD array that we could possibly use. So because we tapped into an order block that tapped an order block would be known as a propulsion block. So our propulsion block would be this up close candle here. So this would be our propulsion block here. All right. So that would be our propulsion block. So we could see a draw on liquidity of coming back up into here for a mitigation. And when we come back up into here, what we can do is find a model on the lower time frames after that. So if we play this forward, boom, we mitigate that propulsion block here. That is our higher time frame mitigation. All right, we get our higher time frame mitigation of a higher time frame PD array, because remember, higher time frame PD arrays hold more power because the candlesticks hold more volume and bulk in the candles. All right, so we got our higher time frame PD array, which is mitigated now, which is this propulsion block here. Drop down to the 15-minute or the 5-minute time frame. We can start to find some sort of model to form for ourselves. Okay, so because of this, we can start to play price out now and see what price is trying to do here. So on the 5-minute, we have a lot of wicks here. So we drop down to the women to see some clarity for ourselves. So because of this, we swept lower time frame buy side liquidity levels here, right? So we swept liquidity here. We swept that liquidity level, and we can delete this order block here because this is our propulsion block. We swept this liquidity level, displaced through here, and now we came back up because what do we have here? High, lower high, lower high. This is an intermediate term high. So this is a major high that we want to pay attention to. We don't want to see displacement past this high. If we get displacement past that high, then that's an indication to us that we might come even higher, or we might be trying to break through this high, or maybe tap into a higher time frame or a higher PD rate up in this range. All right. So because of that, what we want to wait for is what price is going to do now, because we displaced past this inverse here. That was our last fair value gap for an entry point. So what we want to pay attention to is what is price trying to target, because we got a lot of high resistance liquidity. So we want to look at multiple things. We want to look at the 5 minute and the 1 minute time frame to see what price is going to do. So we see price starting to drop here, and once price displaces like this, you see that body close over this most recent low. That is our first break of structure. This is our first break of market structure. So because of that, this is our first mitigation block, alright? This is our first mitigation block that we have encountered. So we have one of two options. We can either enter upon this mitigation block, or we can find a fractal fair value gap that has not been tapped into yet to then use as an entry point. So in this case, there is a fair value gap that is about to form here. So because of that, if we get a mitigation upon this fair value gap here, we can most likely take an entry here. Alright, so let's see what price is going to do. If price comes back up into here, we can take an entry here. Remember, we're using 0.25% size, right? So if we entered here, 0.25% of $100,000 is $250, all right? So if we would create an entry here, we want to risk 0.25%, all right? So I'm going to assume that is going to be about 5 micros here, all right? So if we do that, if price comes back up into here, and see we have huge displacement here. I remember, when price is displacing like this, you do not want to chase it. You do not want to enter price just because it's displacing lower, because it can reverse on you anytime. You do not want to chase price. If you don't get your entry, don't enter. Okay, so remember that. If I'm just giving you an example of what I would do here. I would not be entering until I get this mitigation. But since we get fat displacement to the downside here, we can look at what price is trying to come back into. So we can delete these two trades here. We can look at what price is trying to come down into. So we can see price has mitigated this inverse fair value gap here on the 1 hour time frame, alright? So because we inversed that 1 hour fair value gap, that would have been a draw on liquidity there. So because of that, price can now come back up, use this as support to then come back up into something, because order flow is bearish. Because order flow is bearish, price is going to use bullish PD raise for a retracement. So because this is the first displacement leg in this range, what price is most likely going to do, it's going to use this range as optimal trade entry. So what we can use is optimal trade entry in this scenario and measure out what is OTE. So we can see OTE is here. We let price start to play out now. Price is starting to come up now. Once we get that displacement, that's how we know price is going to be bullish. Boom, we get that displacement over this high. Body close over the high, we get that displacement. So we want to be paying attention to PD rays that are in optimal trade entry. What can we use that's in optimal trade entry? We have this order block. We have this order block as well. and we have this inverse fair value gap here. So we're gonna wait for price to come up into this entry here because this is equilibrium. But I'm not going to take this now because we had displaced all the way down lower, and we can anticipate price would most likely come up higher. So let's pay attention to that fair value gap and see what happens to that gap there. So boom, we would fill this gap perfectly. Once we get this disrespect of it, now we get disrespect of this gap. So this gap is no longer valid because we can anticipate price is going to come up into optimal trade entry. So on the 5-minute time frame, what is an optimal trade entry that we can use for an entry? And we can get rid of this mitigation block as well. There is an inverse fair value gap here that we can use for our draw on liquidity for a short. So this is what I'm talking about, adapting to the market and paying attention to what the market is trying to do. If you're stuck on this 1-minute time frame, you're not going to know what price is going to do. That's why you need to constantly go through different time frames to see what price is drawing to, what price is trying to do. So in this instance, I would definitely start to anticipate to take a short entry here and using 0.25% size. Okay, so once we tap this, we will enter for a trade here. All right, so let's get that mitigation right there. All right, once we get that, we get our body close over it. We did disrespect this inverse, but we are going to enter here having our stops at the most recent swing high, which is a mitigation up here. All right, so because of that, our stops are going to be up here, and we're going to be targeting a 1-to-2 risk to reward ratio. So minimum 1-to-2 risk to reward ratio, and we see we are risking $60 in this case. So because of that, we can risk an extra 1, 2, 3. So we can be risking 20 micros, which is equal to 2 minis on mini contracts, right? And because of that, we are going to be ultimately targeting sell side liquidity, which will be down here, a whole total of $2,120. That'll get us out of drawdown. Most definitely get us out of drawdown. All right. But first off, we want to be paying attention to here. We want to be taking off that 1-to-2 risk to reward ratio to get rid of that original loss we took already, which was a 0.5% loss. So once we get to here, we are going to be taking off a partial for us already. All right. Once we do that, we are going to be letting it ride all the way down to sell side liquidity. All right. So because of that, let's let this thing play out. Price is starting to displace now. Once we get to here, we're taking off 10 contracts, which is 50% of the size. Boom. We get that here. We get our 1-to-2 risk to reward ratio. 490, it's supposed to be $500. $500 is 0.5%. Right here, we're going to buy this, take a partial here, and now we're going to be targeting sell side liquidity. Okay? So because we're targeting sell side liquidity, we're going to let it run. If we let it run and it hits our TP, we would have gained $1,060. All right? Now, we hit our 1-to-2 risk reward ratio, right? Now we're going to be waiting for price to get to sell side liquidity. We're going to let it run. Once we displace past this recent low here, we're going to make our stops to break even. All right? So let's let this play out here. Okay? And remember, you can pay attention to what the market conditions are doing. You can see all throughout morning, throughout AM sesh, we do have high resistance liquidity. So because of high resistance liquidity, we want to be waiting for our macro times, which is going to be at 11:50 and 10:50. 11:50 just occurred, which is going to be our 11:50 to 12:10 macro. After that happened, we filled this gap, and then we're now displacing towards sell side. We now displaced over this low here. This is our next break of market structure, right? So the next thing we're going to do now, because we got that break, we're going to be changing our stops to break even. So let's say we get stopped out on this trade here. We don't lose any money, but we already took a partial, so we're in profit for this trade. But let's say we take this and we hit TP here. We are going to be up $1,060 plus whatever partial we took. Alright, so we can do one of two things. We can hit TP here, or we can let the whole thing run, because remember, you want to let your winners run. So once we hit here, we're going to take another 50% off, which is going to be 5 micros. Alright, so we're going to let this thing run until we hit sell side liquidity. And remember, our stop loss is at break even. So once we hit that sell side liquidity, we're going to take another 50% off. Right about right there. So we're going to take another 50% off. So we're going to buy 5 here as well. And right at this moment, we can move our stops down to our most recent partial. So if we get stopped out here, we would be up $155 still. And what we can do now is, because we can anticipate, this was a market maker sell model. I did not teach you guys this, but this is an advanced model for a lot of ICT traders that you can anticipate based off of basic concepts. Alright, so what we can do now is we can anticipate standard deviation of where we want to put our next take profit. Alright, so how do we do that? We anticipate the most recent manipulation move, or the first manipulation move. Because of that, it's going to be going from there to there. Standard deviation, we want to be looking at least a -2. If we can get down all the way to -2, alright, and we can maybe even move our stops to most recent swing high, or most recent intermediate term high. If we can get down to -2, that is going to be our take profit. Okay, so let's see what price is going to do. And let's say we hit stops, then we're out on this trade already. Okay, let's say we keep going. And just to let price do its thing, let's put it back up to this most recent partial that we took. Okay, and we're gonna let it run all the way to sell side liquidity. All right. You see how price is going back and forth sideways. This is known as consolidation. It's accumulating liquidity. Why is it doing that? Because price has high resistance liquidity right now. You don't want to get chopped up in here. See how small these candles are. And you see how price just displaced lower. Right? Price just displaced lower, created relative equal highs here. So price can do one of two things. It can follow order flow, or it can follow where those stop losses are, which are going to be at these highs. So it's either going to take out these highs and go lower, or it's going to take out these highs and push higher. One of two things. And it totally just ignores it because it filled this fair value gap here. See that displacement there? That's low resistance. That's low resistance liquidity. And if it hits our TP, we are out. And we're going to put our stop loss to our most recent swing high here. And we are out here. So in total, with this whole trade, right? This whole trade. This was one trade, by the way. We took one trade and let it run all the way to down here. All the way to -2 standard deviations. That was our TP. Which is 406 ticks away. 101.50 handles. This was a 1 to 16.92 risk to reward. Also, if we round it up, this would be a 1 to 17 RR. That's a fat trade. That is a fat trade. And this is an intraday trade. And this is what I would have done if I was in those losses. Okay? So we were down 1% drawdown, which is $1,000. Another 5% drawdown, which is what? 0.5% drawdown. Combined, that's 1.5% drawdown. We risked quarter of 1%, which is 0.25. So we risked quarter size and got back all our losses plus profit in one trade. That's the power of having risk management, and that's the power of risk to rewards. We got all our losses back, $1,847. Our losses was $1,500. We got back all our losses plus $347.50 extra in profit in one trade. So, lesson I'm giving to you guys here is, if you are dealing with losses and you are in drawdown, do not feel, just don't feel crappy about that you're in that position. It's all about surviving. So what I recommend you guys do is, when you're in that predicament, lower your risk by 50%. Each loss, lower it by 50% and aim for that 1 to 2 risk to reward ratio. Once you get that 1 to 2, take 50% off at 1 to 2 and let the rest run as far as it can possibly go until it starts to reverse on you. Once it reverses on you, pull it. Alright? This is how you maximize your profits and limit your losses. Other than that, I hope you guys found this video helpful, and I hope you guys can take away from this that not everything is about gambling, and trading is not just gambling. It's about statistics and probabilities. Alright? So, other than that, I will see you guys either in the next video or when this mentorship comes out. Other than that, I will talk to you guys later.